Now, we talked about temporary, 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 permanent, temporary, 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 permanent. Now let's deal with the DTAs and the DTLs to figure out. Oh, first we can say this first entry right here is the current tax journal entry. We've got the current expense and the income tax payable. That goes up by that amount. That's what we get right here, tax rate, and that's our tax payable. So that's our first journal entry. Boom. Now, let's do our little T accounts. Stock compensation, we had recorded $20,000 in PIC, stock options. That's what it shows in our balance sheet from 2001. Well, when we recorded that, we had to do a DTA of 21% times 20,000, which is 4,200. The reason we had to record that is because tax doesn't let us take it until we pay it, but financial lets us take it as soon as we do it. So $20,000 difference times 21% gives us a starting DTA and stock compensation of 4,200. Then we had that change of 28,000. With the 28,000, we deal with a new DTA, not a new one, but like adding to the old one that we had. 28,000 times 21% gives us the 5,880. And when you add those together, you have a 1080 here, $10,080. Jumping down to the DTA for the legal thing, you'd recorded $25,000, but you weren't allowed to take that for tax yet. So you multiply that by the 21%, and that gives you a starting balance in your DTA, a debit balance of $5,250. Now, this year, you get to take it. So this is that whole right here, the $25,000 temporary difference reversal. We're reversing the DTA. I don't know why there's a question mark here. We know that that's true. So we decrease it by 25,000 times 21%, and that gives us our 5,250 right here. And then that balances out, so the DTA goes down to 0. Equipment, we'd kind of talked about before. We had a difference of a taxable difference of 2,000, so we multiply that by 21% and get 420. And then this year we had more of that, 1,000, so 21% of that is right here. And okay, sorry, I had to respond to something. 420 and 210 equal the 630, and that's what it tells us here on number 7. It gives us those answers. Let's now jump down to the pension. Remember, we had recorded the $5,000, but tax doesn't let us take it until we pay it. So we have our liability of 5,000 from 2001. 5,000 times 21% is 1050. And then this year, we had to unwind $3,000 of that because we are undoing that. We're catching up. We deducted 5,000 for book, but we got to take off 8,000 for tax. So we're undoing that DTA by $3,000. And when you multiply that by the 21%, it gives you 630. So the net DTA there is 420. And then the investment. Well, the investment started at 0, and we were able to add back the 630. I can't say numbers right now. 630. You come up here, you've got difference of 9,000 plus 2,100. That gives you 3,000. When you multiply that by 21%, it gives you 630. Or you could do this one individually and this one individually. You add them up and it still equals 630. So you've got 630 here. That gives you a DTA of 630 there. Then it tells us that the valuation started at 10,000 and ended at 1,200. So we know that the debit has to be 8,800. Now, step 7 on here, step 8 says determine if there's a valuation allowance. In this case, she just gave it to us. So we would normally have to do the whole, is there business income in the future? Is there an NOL and all that stuff? Well, it just gives it to us here. So thankfully, we don't have to worry about the valuation. Now, let's figure out our journal entries. So, actually, let's come over here. We know that in 2001, the net DTA was 80. It was $80, and we have that from our balance sheet, that it started at 80 in 2001 as a deferred tax asset net. Well, we know from what it gave us that 420 was our DTL. That's this right here, over here on the equipment side. And so if we know that that is 420, and we know the net was 80, and we know that the valuation had a $10,000 balance, that it gave it to us that way. It told us that it was $10,000. We know that our DTA had to be 10,500 because 10,500 minus 10,000 minus 420 is 80. So we knew that that was the balance that it was before, and if you go and sum up all of the beginning balances and the DTAs, you'll find that that is true. 2002, I haven't fixed this one yet. It would be 993, I think, right? No, 9930. Yeah, there we go. So 9930, I'd forgotten to add in the 630 that we had messed up on earlier. So we know that the net DTA has to be 9,300 because it tells us that that is the case, I think, right? Yeah, it tells us on our balance sheet that that is the balance. So that's our net, and this is our DTL that it tells us in the little additional information. So when we add up all of the stuff, we know that these check out because this is what it gave us in the balance sheet, this is what it gave us in the information, and this is what we solved for. And if we add up all of these T accounts with the valuation and everything, I would go ahead and add here that the, I'm not going to worry about that. You can do the T account stuff yourself. Let's jump to the journal entries, which is really the most important part. And this is probably where people want to start looking at the video to understand what they were missing. Current one we already figured out. And then the journal entry for the DTAs and DTLs, you just have to figure out all of the changes. So this one right here, you go to all of the different changes. This is a change, this is a change. Ignore the beginning and the ending balances, just do the changes for the period. And that's where you put the credits and debits here. You realize that you have extra debits at the end, so you have to credit the deferred tax benefit of 420. Valuation journal, it gave us the information that 10,000 starting, 1,200 at the end, so we know that 8,800 was the plug. We add that as a debit to the valuation allowance to decrease it, and that then increases our deferred tax expense. Now, the UTP. This one's a little bit confusing. The UTP, it tells us, is 6836. And a UTP is basically like the company saying, okay, we're going to claim that we don't have to pay these taxes, $68.36 worth. And there's a lot of more complexity that goes into it where you'd say, I don't think I have to pay 10,000, but I have a 68.36% chance of that being true, something like that. So that's how you get that number. It's tax stuff beyond the scope of what we're doing in financial. It just gives it to us in this case. And it says, we don't think we're going to have to pay this, but if we do, we need to record a liability just in case. So we say current tax expense because it happened right now. We're trying to lower our taxes. We're taking a tax position that's pretty aggressive and saying we're not going to pay these taxes, but we want to record the expense and the payable right here just in case we have to pay it. And so that's why this journal entry is the way that it is. It gives us this number and it says this period we're not going to pay this amount, but we want to expense it and record the liability just in case to show our shareholders, hey, we might have to pay this, because if we didn't record it and then we had to pay it, our shareholders would be like, why the heck did you not record this? Like, that deceived us. So they'd be mad. So I think that kind of explains all of the things that we have to do. The required part is prepare the tax provision, including the journal entries that would be made. These are the journal entries in blue. Then you just go through and say current tax expense, deferred tax benefit right here, and then deferred tax expense and current expense, and you would net those together. That answers, I think, everything. Good luck on the final, and hopefully that made sense. Sorry about the rusty video. I was just doing it on the fly.